All right, so we are still in chapter 7, learning objective 7. We've talked about accounts receivable. Now we're going to talk about notes receivable. Okay, remember, notes receivable has an interest element to it. Okay, has that interest element. And I believe when we go through this, we might be just using simple interest, but we've already done compounding interest, so it doesn't matter what they throw at us. Okay. Notes receivable have an interest. It could be current or long term. If it is greater than a year, then it's going to be long term. Okay. So you have to kind of read the problem and it'll tell you how many months. It'll may say a year, 2 years, or however many months. And then you have to decide, does it go into long term or current? Okay. So there is that interest element. Looks like they're making us do simple interest. So face amount, we sometimes call that the principal times the rate, the percentage, and then time. Okay. Because all percentages are quoted at an annual amount. Okay. So they give us an example here. This is Stradwell Wholesale Shoe Company manufactures athletic shoes that it sells to retailers. On May 1st, 2027, the company sold shoes to Harmon Sporting Goods. They agreed to accept a 700,000 6-month 12% note in the payment for the shoes. Interest and interest is receivable at maturity. Assume that the interest rate is 12% is appropriate for the note of this type. Okay? So they have the principal multiplied times the rate multiplied times 6 divided by 12. Okay. The first entry doesn't include the interest. They went ahead and did they've got the interest calculation, but they've got it pointed down. So the first entry does not involve interest of any kind. We are just recording the sales revenue and debiting the notes receivable. Okay. Maturity value is just the principal plus interest. Okay, so in this case, it'd be 742,000. Okay, they did this in May, so if you count, you've got May, June, July, August, September, October. Okay, so your 6 months, so it should be due end of October, beginning of November. Okay, they're going to get 742,000. That's the maturity value that I mentioned up there. We're going to credit interest revenue of 42,000 and credit the notes receivable. The one thing to be aware of in these problems, if that term on that, so let's just say, for example, instead of that being May 1st, it was November 1st. You would have to make an adjusting entry at 12/31 or whenever they do their financial statements, you'd have to accrue any interest that you've earned. Okay. So I guess they're going to give us one of these. And so look at that. It's like I had read the slide before. If the sale occurred on August 1st, 2027, and the company's fiscal year end is December 31, then you have August, September, October, November, December. You have 5 months. You can't see me, but I just counted on my hands. Okay. 5 divided by 12. We have to get the interest for those 5 months. Nope, we have not gotten the cash, but we have earned interest revenue. So we'll debit interest receivable, credit interest revenue. Okay. Now we're going to come on down. The maturity value is still going to be 742,000. So they are going to get cash of 742,000. That's not changing. Okay. We're going to record a month's worth of interest. And you can see if you took the 7 plus the 35, that gives us 42,000, right? And so sometimes it really helps to get a timeline here. So you can have 12/31, 8/1, and then February 1 right here. Okay. So you can see how you get 5 months here and 1 month there. Okay. So interest receivable just held the $35 so we could get it as an asset and get it as a revenue on the previous year's financials. Okay. Just holds it until we actually get the cash. Then we'll credit notes receivable. Remember, do not add any interest into that notes receivable account. Okay. We had a whole different receivable, and that was interest receivable. Okay. All right, let's look at short-term non-interest bearing. Sometimes they will discount these notes and like there won't be as much you won't get as much cash right now. That dollar amount is lower than the dollar amount that's going to be paid back. So there's some implied interest. Okay. So even if they said nothing about it, interest, but there still is an interest element. I know it sounds like an oxymoron, doesn't it? Non-interest bearing notes that actually do have interest. Okay. We do keep the other in a contra account that goes along with the notes receivable. So let's go through this problem. Okay. Stradwell Wholesale Shoe Company sold shoes to Harmon Sporting Goods on May the 1st, accepting a 6-month, $700,000 non-interest bearing note in exchange for delivering goods that have a cash price of 658,000. Okay? So we take the 700,000 and subtract 658. Is that 42? We do have 42,000 of implied interest. Okay. Um, I don't know why they have, okay, I see what they're doing to get that 42. All right. So they're going to record the notes receivable at the face amount, the 700,000, because they have to do something with it. They accepted a note right here for 700,000. So we have this contra discount on notes receivable. Okay. So let's come up here and draw a T account. We have notes receivable of 700,000. Remember, like your bonds, we had that contra liability count. We're on the opposite side of the equation, but it works just the same. Okay. Discount on notes payable. We'll have a credit of 42,000. And both of those together have a book value of the 658. Okay. So time goes on, May, June, July, August, September, October, or November 1st again. We will debit the discount on notes receivable right there, and that will go away. We're going to record interest revenue of 42,000. Now the book value of that note is the 700K because 42,000 of it was interest. Okay. So we're going to debit cash 700,000 and credit notes receivable of 700,000. Okay. So even if it's non-interest bearing, it still has interest. Okay. Here they give us an example. Stradwell Wholesale Shoe Company sold shoes to Harmon Sporting Goods, same thing. May 1st, accepting a 6-month note, 700,000 non-interest note in exchange for delivering goods that have a cash price of 658. What is the effective interest rate for Harmon paying? Yes, we used 12% to calculate it. But due to compounding, it will yield a little bit more than that. Okay. So we took the 42,000 divided by 658, gave us 6.383, but that was only for 6 months. So we're going to multiply it times 2 to get the effective interest rate. So a lot of times how you'll see this in in ads, they may say 12% interest, but then they may say something like the 12.766 yield, something like that. Okay. Because it's a little bit more due to compounding. Okay. All right. So let's do another one. They said if Stradwell Wholesale Shoe Company made the sale on August 1st, the December 31, 27 adjusting entry and entry to record the cash collection would be. Okay. We did this one. We're just assuming now it was non-interest bearing note. Okay. We debited that discount on notes receivable for 35. Remember, we had the receivable, but we have that discount on notes receivable now. So we're going to take 35 of that. We're going to earn 35 of that revenue. The other seven will be earned in that first month in 2028, and then they will get cash back or cash of 700,000. Okay. All right. Now let's look at Stradwell Shoe Company manufactures athletic shoes, and on January 1st, the company sold shoes to Harmon, and they agreed to accept a 700,000 two-year note. What do we know? If it's 2 years, it is a long term. Okay. In payment for the shoes, assume a 12% effective interest rate. Okay. So they use those tables to go find that factor and to do the present value. Remember, you know how to do this in your TI-84 calculator. We spent weeks on it in financial management and we spent some time doing it here. Okay. So I think your calculator is much more efficient than to look at those present value tables and those factors. And the problem is if this number was really big, these numbers only go out so far. So if it went out 1, 2, 3, 4, 5, 6, if this was more than 6 decimals, like let's just say it was a billion, you'd have a huge rounding error with using those percentages. You're going to have a better number with your calculator. Okay. They found that number by looking at the present value of one, number of periods, and interest rate of 12. Okay. So they're going to discount that. That notes receivable will sit there for 700. Okay. And then they found what is the present value. If you were putting in your calculator, you're looking at what's the present value of us receiving 700,000 in 2 years at 12% interest. Okay. And the present value of that is $558.37. So 558.36. Okay. Then everything else is going to be interest. Okay. So here's where it's really important. I would draw those T accounts out. Okay. You have 700K there. You have, I don't know why I wrote allowance because I just did allowance stuff yesterday in principles. Okay. So the discount is 141,964. Okay. So we come down to the end of year one. They made this nice and pretty for us. They took the book value of this, 558,036, multiplied it times 12% to get this number right here. They're going to debit that discount on notes receivable and credit interest revenue. Okay. Discount. Let's look over here at the T account for that. 66,964. Let me pull a calculator up really quick so that you can see. Sorry about that. So there's my calculator. There we go. Coming back. So we have 141,966 subtract 66,964. And that will leave us $75,002. There's a little bit of rounding error there. Little tiny bit. Okay. It's okay because what they would do, especially with this note being paid off, if there's a tiny bit of rounding error, they're going to zero that out. They're going to make that because the note's going to be done. They'll just zero it out with that little bit of rounding error. Okay. So they'll debit the discount. We know that's probably not really accurate, but nonetheless, it's okay. And then record interest revenue for the other 75,000. We get cash of 700,000 and then we credit that notes receivable. Okay. We're going to skip that concept check. Okay. Notes received solely for cash. Sometimes we're just loaning somebody money. And that's okay. We can do that. It would look really good to your auditors if it's an arm's length transaction. It's not a related party. Okay. So we're just loaning money. We're going to debit notes receivable, credit cash. Remember, cash is really just a check. They're going to write them a check for $700,000 and they're going to take it to the bank and cash it. Okay. All right. Subsequent valuation of the notes receivable. So if a company anticipates bad debts on their short-term notes receivable, it will use an allowance account to reduce the receivable down to the appropriate carrying value, just like we did for accounts receivable. We can do the same for notes receivable. Okay. Um, we're going to include some reasonable, supportable forecast about the future. Past experience usually tells you a lot of information. Past experience, coupled with what's our economy looking like right now, things like that is how they make those estimates. You're not going to have to make those estimates in here. I wouldn't even know how to tell you to do it because I'm not a forecaster. Okay. But it is, you do need to have something to back that up. Okay. So I'm gonna kind of skip IFRS a little bit. All right. Financing with receivables, we could pledge those accounts receivables as collateral for a loan. I'll be honest, if I see this happening, I'm probably going to be like, why are they not managing their cash better? Because that's kind of what it signals to me. Okay. If it's secured borrowing, it's still the responsibility for collection of the receivables remains with the company. We're just pledging it. Okay. No special accounting treatment is needed. Okay. If you sell those receivables, then it can be sold, probably not going to be sold at a gain. It'll probably be sold at a loss. And the accounting treatment is similar to selling other assets. Like if we sold property, plant, and equipment, we're going to look at the book value and see what our gain or loss is on the transaction. Okay. I've already talked about both of those. Okay. It could be to open up a line of credit. You kind of have to pledge your receivables. Um, okay. There could be an assignment of particular receivables to serve as collateral for loans. Good example of this right here is mortgage on a home. Our mortgage loans change frequently. Another company will buy out loans from one company, and then we have to change from paying. It's kind of a pain sometimes because I have to go and change um, who we're actually paying our house payment to. It changes sometimes, not frequently, not like all the time, but every couple of years. We've never had one mortgage and it was the same mortgage company forever. It changes from one to the other every couple of years. Okay. So that happens a lot when it comes to mortgages. Okay. So here they give us an assignment of the accounts receivable on December 1st, 2027. Santa Teresa Glass borrowed 500,000 from Finance Bank, signed a promissory note under the following arrangement. So they assign 620,000 of its receivables as collateral. There's a finance bank charge, a finance fee equal to 1.5% of the accounts receivable. Santa Teresa will continue to collect the receivables and will record any discounts, sales returns, and bad debts write-offs, but it will remit cash to Finance Bank on a monthly basis. Interest is 12%. So they are going to credit notes payable because they're borrowing money basically. Okay. They're going to debit cash. That's how much cash they're going to get. And the difference, the 620 multiplied times 1.5% is 9,300. Okay. So that's their finance charge. Okay. So we have all that information. I think they're telling us a lot of this information over again. So then it says Santa Teresa collects 400,000 of the receivables in December. So they're in a debit cash, credit accounts receivable. Okay. Then they are going to send that cash plus interest to the bank. Okay. So I believe this was this 1 month after they did that, or within the month. Okay. So 500,000 multiplied times 12% multiplied times 1 divided by 12. Okay. Because that's how much we owe them. Okay. That notes payable is sitting out there with 500K. Okay. So now they collected 400,000, so they are going to bring that notes payable down to 100K. Okay, and they had to pay an interest on top of the 1.5% finance charge. Okay, that's why this kind of debt's really expensive. Okay, um, so you can see they drew our T accounts out here for us. I drew the one for notes payable. There was 620 in the accounts receivable. They collected 400,000. They have 220,000 left. Okay. So when let's just say they don't do anything else with this problem, let's just say in the next month they collect another 100,000. They're going to pay this 100,000 plus any interest for that month. Okay. All right. We're still talking about sale of receivables. If you sell them, okay, this is like what I've talked about, like on our home mortgage. It actually removes the receivables from the accounts, okay, recognizes them as the fair value, okay, acquired or liabilities assumed, okay, and then the difference will be a gain or loss. Okay. Sale of receivables could be under a factoring arrangement. We have the company, they sell the accounts receivable to the financial institution, and then they can buy the accounts receivable, charge a fee, and then the responsibility of billing and collection is on the financial institution. Okay. Then we have with recourse or without recourse. Okay. So let's just say, okay, so if it's without recourse, the buyer cannot ask the seller for more money if the receivables prove to be uncollectible. So you've sold those receivables. Let's say you've sold them for $500,000. You only got 450,000 and 50,000 was uncollectible. That's not our fault that they couldn't collect it all. Okay. If it's without recourse, the buyer assumes all of the risk. Okay. With recourse, there will be some more risk that the seller would incur. Okay. All right. This is a big long problem here. So let's muddle through it. Santa Teresa Glass Company entered the following factoring arrangement. Santa Teresa transferred accounts receivable that had a book value of 600,000. The transfer was made without recourse. The factor immediately remitted to Santa Teresa cash equal to 90% of the amount. Okay, so they're losing $60,000 right there. Okay, just because they probably need cash to pay their bills. Okay, not the worst thing in the world, but it would make me suspect if I was an auditor. Okay. The factor retains the remaining 10% to cover its factoring fee, equal to 4% total amount times the 600,000, which will be 24,000, and provide a cushion against potential sales returns and allowances. So after the factor has collected cash equal to the amount advanced plus the factoring fee, factor will remit excess to Santa Teresa, and Santa Teresa has a beneficial interest in transferred receivables equal to the fair value of the last 10% of the receivables to be collected. I know that's a lot, isn't it? Okay. So I always tell y'all, start with what you know. Okay. Start with what you know. We know that we are giving them $600,000 of receivables. So we're crediting that account. And they told us that we are debiting this account for 540,000. Okay. We had receivable from the factor. They had 50,000 minus the 24,000 fee, which is right there, gives us 26,000. And then this number right here is a plug. Okay, you just plug it with the others that you know. So it's a loss on the sale of receivables. Okay, all right. I'm going to jump on down. Okay, sales with recourse. Okay, this is when the company sells receivable with recourse. The seller retains all the risk of the bad debt. Okay, so we're going to look at this. It looks like the same illustration, except we are going to have with recourse, estimates the value of recourse obligation to be $5,000. Okay. So what changes in here, remember, get the things straight that you know, get those two first of all. Okay. We're going to record a recourse liability that way if they can't collect them all, we have to pay that. Okay. And then that 5,000 changed this loss to 39,000. It was 34,000. Okay. So it made the loss go up because now we have a liability to them. All right. I think that should be almost all of learning objective 8. And I know this video is getting long, so some of this, if you wanted to pause and work through some of those, that's fine. I don't want to run this video out 37 minutes like I did the last one, okay? So, there's a really nice summary slide right there that would be great to look at before you take the test. Okay? All right, I think we are done with that learning objective. There we go. We will pick back up on these ratios in a few minutes.